Hello, I'm Mario Becker from Das Family Office. In the following video, I'm summarizing the events of the first quarter. I hope you're finding it useful. The first quarter actually started pretty well, more or less continuing the trends of last year. That means emerging markets did very well, Asia did very well, even Europe. But naturally, the attack on Iran changed everything. Since then, pretty much throughout all of March and now well into April, we could see a dramatic rise in oil and gas prices, which naturally has a big impact on inflation assumptions. You could argue we should worry more about the people involved in the war and suffering from the war and dying in the war, but financial markets can be very, very brutal. We could see that in Gaza, where effectively there was no oil in play, so the world unfortunately quickly forgot about it. But this time around, as oil is relevant for everybody, oil and gas, we're all worrying about it, and we're all worried about price increases and the impact on inflation, on our purchasing power and everything. It's actually pretty cynical, but that's how economy works. That's how the stock exchanges work. So what we could witness in March was pretty much only oil stocks did well. Surprisingly, defense stocks did actually worse than the market overall. So I guess that came as a big surprise to many people, because recently I've been getting a fair bit of inquiries about defense stocks, and naturally I'm not a big fan of this segment, but I have to admit that the sector did slightly better than global equity markets ever since we have data from the early 90s. So I can't ignore interest in the segment. At the same time, I would highlight that the technology sector has done much better. So if the objective is really to make more money, then I think you may be better off staying with technology stocks rather than shifting into defense stocks, aerospace and defense stocks. They're actually also quite expensive at the moment, and maybe that's the reason why they did worse than the market, because March clearly saw a fair bit of profit taking and probably also a fair bit of margin calls. So people were selling what had been doing well before, which means defense stocks, which meant most of all gold mining stocks, copper mining stocks, Korean semiconductor stocks. All of these sort of darlings of January and February saw a brutal correction in March. Still, most of them are up for the year. So while, let's say, some latecomers who bought these stocks at the end of January or end of February may be nourishing losses now, people who bought them last year are still on the upside. So net, I would say, especially if you've been investing in the market in a broad way, the result isn't as bad as the news headlines would make you think. So the broad global equity market, based on the MSCI World All Country Investable Market, or the FTSE All World Index, is down about 5% in US dollars, just shy of 5%. And if you think about what happened to markets last year, April, when Trump announced his tariffs, the market reaction was much stronger. Where we saw quite a bit of response was in these darling segments, but also in the technology sector, as well as in non-profitable growth, as you can see, for example, from the Russell 1000 Growth Index. So stocks that are not making money just yet, but are expected to be the winners of the future, they had a rough March. And that's why people who have been building portfolios around this idea are probably seeing much bigger losses than the market overall. Where we've also seen, I wouldn't say dramatic, but heavy losses was in the stocks of private equity managers as well as private credit managers. They're down easily 25%, and that's naturally painful. On the fixed income side, we can also say there were largely losses. Only money market held stable, which is expected. But through all duration segments, there were small losses, somewhere between 0 and 3%, not overly dramatic. We also saw correction in what I tend to call specialty bonds. That means emerging market bond, tier 1 capital, high yield bonds. The credit spreads have widened here. There are some losses in the range of 1 to 3%. Again, you could argue it's not overly dramatic. It's in line with expectations and nothing like what we've seen last April. Where does this leave us? Obviously, we don't know what Trump will bring, what the war will bring. Have we seen the high in oil prices, or do we have to prepare ourselves for oil prices which are much higher? But I doubt it can get that way, because that will clearly not allow Trump to win the midterm elections. And I think there is already a lot of pressure on him and on the various players in the Middle East to do something about the high oil prices. But never say never. But in the absence of such dramatic escalation of things, I think we can state that at this point in time, valuations of both stock and bond markets are currently attractive. Even the Nasdaq 100 and the S&P 500, as well as the traditional MSCI World Index, which is heavily weighted towards US large companies, are actually now showing a risk premium which is slowly creeping towards 6%. We had actually suggested to stay away from these stocks and these market segments because we found them just too expensive, and it didn't make sense to buy them in comparison to even money market rates. That's not to say that they're now excessively cheap, but they've moved out of the incredibly expensive into the, let's say, modestly expensive valuation range. That's why I'm prepared to mark them as yellow in our valuation traffic light, which many of you know already. So overall, the adjustments have led to better valuations, and naturally that makes sense for people who look to invest, that after a correction you should see better prices, which we currently do. So overall, we're seeing good valuations, especially in the fixed income side, but also typically in the equity market, in the various equity markets. Even India is now trading at a projected forward PE of just about 16. That's a valuation we haven't seen in a long time. So I'm prepared to say that the current environment is good for long-term investors. That said, it's very important that you monitor your cash flows. It doesn't make sense to invest money that you need fairly soon, so that money has to stay in the money market fund. At the same time, money where you know you will definitely not spend that in the next 10, 15 years, that can definitely go into a broad-based intelligent equity strategy. Because whether you buy your long-term equities 5% cheaper or not doesn't really make much of a difference. So I would encourage you to also not start market timing. Just get going, get invested. Yeah, what I'd also like to highlight the various benchmark portfolios from Dimensional Fund Advisors, which we're using for our quarterly client reviews as well as for general communication. They've done extremely well in the first quarter and are showing significant outperformance versus traditional equity indices such as the MSCI World. And it's up about 5 percentage points. This makes me very happy because we're looking at these very diversified global allocation ideas as benchmarks, investable benchmarks. They're very cheap to implement. They only cost about 0.25 to 0.3% annual management fee. And I like to use them as benchmarks vis-a-vis what we do. So we should be able to outperform these world allocation portfolios with what we do. At the same time, I think they're a good orientation vis-a-vis the discretionary portfolio management of private banks. I'm quite critical of those because I find them typically very badly managed and much too expensive. So I like to highlight these world allocation portfolios, which exist in pretty much all relevant currencies, because I think ordinary investors that are really not very passionate about markets could take a close look and be very happy with the results. And yeah, now for the first time since the formation of Das Family Office, we see these benchmark portfolios outperformed by a significant margin, which is a function of the fact that small company stocks are doing quite well and that global currencies are still holding up quite well against the US dollar, which is why they're doing well. And I think there's good reason to expect that this could continue. So please ask us about these portfolios. It makes sense to add them to your portfolios. So so as a result, I would say we can buy tech stocks again, so we don't have to worry too much about the valuation at the current point. So I would suggest buy tech stocks instead of defense stocks if you're worried about performance, or if you'd like to have extra performance. I think in the long term, you'd be better off buying high quality tech stocks, and you can do that through a broad-based index, which we have in our recommendation list, as well as the very well managed fund from Threadneedle, managed by Paul Wick, a gentleman I've mentioned several times. This would be much better than buying aerospace and defense stocks, if you ask me. So take a look at that. At the same time, I'm also really skeptical of oil stocks. Yes, they're currently doing well. They're also not too expensive, and their free cash flow yield of about 8% looks attractive. But what if they start investing again? The cash flow yield is as high as it is because they haven't been investing in a long time. So once they start investing again, that cash flow will go into investments and will not be distributed to shareholders. If you look at the MSCI World Energy Index since about the early 90s, you could see that yes, they've been matching the global benchmark, but they didn't outperform really. And if you look at the last almost 10 years since the global financial crisis, they've actually underperformed the broad market in a significant way at about 6% annually. So I would rather draw your attention to the so-called clean energy segment. That means companies that are making our electricity infrastructure more efficient and help to build the electricity infrastructure of the future. These companies are investable via an index from NASDAQ. It's called the NASDAQ Clean Energy Infrastructure Index. It's been calculated since about 2008, and that index has performed annually at about 12%. It's been beating the MSCI World Index. It's been clearly beating the energy index, the traditional energy index. So I think now that we have another oil crisis, it's highly likely that governments and companies will invest in modern energy infrastructure and move even quicker away from oil and gas. So please take a look at that. That would be my recommendation. Buy clean energy infrastructure via the ETF grid rather than chase the oil sector. Yes, oil sector may be a trade for now, but I don't think it's a long-term strategic idea. And lastly, I've been receiving inquiries, and I've also been reading about this in the newspaper, that people are being chased to participate in the SpaceX IPO. And I think you should be quite careful here, because there are companies that are exploiting potentially your interest and potentially also your greed. And this makes not a lot of sense. They're setting up typically SPVs for high fees with upfront charges and high annual management fees. It makes no sense. It's much too expensive. We've been investing in SpaceX indirectly via VenCap, a fund-of-fund manager, which we like. They've been investing in SpaceX for a long time, and we're actually looking forward to exiting the stock. I think at the valuation that are currently being mentioned, you want to be a seller of this stock and you don't want to be a buyer of this stock. And if you really need to have it and you don't want to overpay, there's the Scottish Mortgage Trust, ticker SMT London. They have about 15% of SpaceX in their current portfolio, and it's even trading at a discount of about 5%. So please don't entertain anybody who wants you to buy SpaceX at probably very high valuations. Ignore that. There's also the stock EchoStar, which has a major shareholding in SpaceX that could be a proxy. So rather look at this one, and please don't buy into any of these structures that people may chase you with. At the same time, you could argue, why worry about SpaceX now? That story is largely done. Shouldn't we worry about the future SpaceX, the future OpenAI, the future Anthropic? And yes, venture capital is very tough, and I think it's too dangerous for most of us. But given that we know a company such as VenCap there's an opportunity to participate in such ideas and the winners of the future. They've been doing it for a long time. They regularly come to Singapore. So if you're really keen on adding a growth bucket to your portfolio, a long-term growth bucket where you're also prepared to put money away for at least 10 years, talk to us. I think that makes much more sense than getting the last 5 to 10% that can be taken out of SpaceX. All right, I hope we will all be enjoying a more peaceful second quarter. Wishing you all the best, good health, and stability in the Middle East and lower oil prices. I think that's something we would all like to see. All the best.